Welcome back to Smart Stock Sam, the channel where we don't just talk about the market, we read it before it moves. What does it feel like to watch a prediction you made, one built on real data, real mechanics, real institutional behavior, play out almost to the dollar? That is exactly what happened with HIMS stock. In a video published right here on May 23rd, this channel told you specifically, do not catch the falling knife. Wait for the technical triggers, wait for the institutional confirmation. And then it happened. The stock bounced off the exact support floor we had mapped. An insider dropped over $1 million in the precise Fibonacci confirmation zone we outlined. The options wall at $25 shattered on cue, and by June 1st, the stock closed at $27.76, a single-day gain of 6.16%. The forecast was not lucky. It was mechanics. And today, we are going back in deep to break down every single driver behind this move, the pivot, the spark, the squeeze, and the ceiling, so that you know exactly how to position yourself in HIMS for the days ahead. My HIMS stock prediction played out perfectly, and now it is time to show you precisely how to trade what comes next. Stay with me all the way through, because there is one specific price level sitting directly above us right now, acting as a concrete brick wall, and if you do not know where that ceiling is, you could be the one left holding the bag while institutional money quietly walks out the door. Now, to understand exactly how this powder keg was ignited, we need to zoom out and look at the four core pillars driving this entire movement simultaneously. Think of them as four separate gears, all turning at once, locking together into one massive engine. First, there is the pivot. The company is rapidly transitioning away from controversial compounded GLP-1 drugs toward an FDA-approved integrated global health ecosystem. Second, there is the spark, a $1.17 million open market purchase by lead director David Wells at $24.23, which flashed an unmistakable signal to the entire market that the worst-case scenario was fully and completely priced in. Third, and perhaps most dangerously for anyone sitting short on this name, there is the squeeze, an explosive 30.05% short float consisting of 63 million shares colliding violently with dominant call option volume. And finally, there is the target, a highly specific setup testing the $29.53 debt conversion ceiling. That number is not random, and I'm going to explain precisely why it is the ultimate boss fight for this stock. But before we get there, let us walk through the forecast that started it all. If you watched the May 23rd video on this channel, you know I gave a very specific warning. Do not buy yet. Wait for defined technical triggers before you touch this name. So let us look at what actually unfolded. On May 26th, the stock found its intraday low at $23.36, bouncing directly off the structural support floor we had already mapped days earlier. That alone was significant confirmation. But the real conviction signal came when lead director David Wells stepped in and purchased shares in the $24.23 to $24.25 range, providing the exact Fibonacci retracement alignment we needed to validate a genuine reversal. By May 27th, the stock blew clean through the $25 options wall, forcing market makers to scramble and aggressively hedge their positions, generating forced, systematic mechanical buying that accelerated the move. And then, on June 1st, it powered past our $26 gap fill target and closed at $27.76. The sequence was textbook. Every level held. Every catalyst fired in exactly the right order at exactly the right time. That is not coincidence. That is pattern recognition meeting fundamental mechanics in perfect sequence. But here is the thing. Technicals alone do not sustain a move this aggressively and this persistently. You need a real fundamental shift underneath the price action. And for HIMS, that shift started with what looked to the casual observer like a complete and total disaster on the balance sheet. In Q1, the company reported a brutal headline number, a $92.1 million net loss. Retail investors saw that figure and panicked immediately. Social media filled with disaster narratives overnight. But here is what the smart institutional money saw. Buried inside that headline loss was a $33 million inventory write-down. And that write-down was not a failure. It was a calculated, deliberate, strategic exit from compounded GLP-1 weight loss medications. Management looked hard at the regulatory gray area surrounding those compounded drugs and decided the long-term risk was simply not worth carrying. So they absorbed the short-term capital hit on purpose to protect the company's structural longevity going forward. Would a company truly in crisis willingly take a $33 million charge as a strategic move? Or does that sound far more like a company clearing the deck to build something bigger and more defensible? The answer is obvious, and that pivot is not a theory on a whiteboard. HIMS is executing it through three massive and very concrete growth pillars. The first is international expansion. The company just closed a $1.15 billion acquisition of Eucalyptus, instantly opening direct operational gateways into Australia, Japan, the United Kingdom, and Germany. That is not a startup cautiously exploring foreign markets. That is a company with serious capital, making a serious, committed geographic bet. The second pillar is Canadian GLP-1 disruption. Following Novo Nordisk's patent expiration, HIMS partnered with Apotex to launch a generic semaglutide for just $149 Canadian per month, completely undercutting every existing competitor in that market. Think about the subscriber acquisition potential when the branded alternative costs multiples of that figure every single month. And the third pillar is holistic benefits integration. On May 28th, HIMS added 8 new wellness partners to their platform, including MyFitnessPal, HelloFresh, and Dexcom's Stelo biosensor. Here is the detail that makes this genuinely compelling. They are integrating these partners without taking any profit cut whatsoever. Zero margin extraction. The strategy is purely retention-driven because sticky subscribers are worth exponentially more than churned ones across a multi-year model. Now, despite all of these brilliant strategic moves, the stock was still bleeding for weeks leading into late May. So what finally flipped the entire narrative overnight? One man, David B. Wells, lead director and former chief financial officer of Netflix, walked into the open market and purchased 48,400 shares at an average price of approximately $24.24. He deployed $1,170,000 of his own personal capital. This was not a scheduled purchase under a pre-arranged plan. This was his first open market buy in 5 full years, and it increased his personal ownership stake by 27%. Let me ask you a direct question. Does a person sitting at the absolute highest level of a company's board drop over $1 million of their own money into a stock they privately believe is headed lower? Does that action make any rational sense at all? The market understood the signal immediately. The stock surged 6.8% in a single session on the back of that purchase alone. That is what we call a sentinel signal, a moment when the smart money inside the building raises a flag so visible that the rest of the market simply cannot ignore it. And while that insider buy lit the fire, the institutional picture tells a fascinating second story running in parallel. Total institutional ownership currently stands at 76.74%, representing over 171 million shares. Yes, there was a 5.96% reduction, roughly 10.84 million shares liquidated as conservative equity funds de-risked in direct response to the Q1 inventory write-down. But here is the critical detail that most retail traders completely missed. That exited equity capital was almost immediately replaced by aggressive and highly concentrated options speculation. Firms like Citadel and Susquehanna may have trimmed their raw equity positions, but in the derivatives market, they are expressing overwhelming and unmistakable bullish conviction. The institutional whales did not leave the building. They just quietly moved to a different floor. and Wall Street's analyst community is equally and dramatically split right now, which is actually a very telling sign of exactly where we are in this stock's cycle. On the bullish end, Needham & Company has placed a $35 price target on HIMS. JP Morgan follows closely at $33. Citigroup sits right near the current price at $28. But the bears are still extremely vocal. Truist holds a $23 target. Bank of America recently downgraded their target to $25, citing elevated churn risks and one very specific and daunting operational challenge. HIMS needs to acquire 225,000 oral Wegovy subscribers every single quarter just to meet their 2026 revenue guidance. That is a significant mountain to scale each quarter without a single stumble. The analyst divergence, stretching from $23 all the way to $35, tells you one thing with absolute clarity. No one has convicted certainty here yet, and that tension is precisely what creates the volatile, explosive price action we have been watching unfold. Let us strip away the opinions entirely now and look at what the raw technical data is actually reading. Across the board, HIMS is flashing a confirmed strong buy signal. The 14-day RSI is currently sitting at 72.58. That confirms extreme bullish momentum, but it also carries a loud caution flag. We are officially in overbought territory. Chasing this print at current levels without a healthy pullback first is a genuinely dangerous game. The MACD is posting a reading of 0.85, confirming buy signals across the 5-minute, hourly, and daily timeframes simultaneously. But the single most important technical development is the moving average structure. The stock has cleanly cleared its 50-day moving average at $24.95, and far more critically, it has reclaimed its 200-day moving average at $26.09, successfully flipping that level from resistance into hard support. A stock that reclaims its 200-day moving average and defends it on a retest is not simply recovering, it is structurally resetting into a new phase. So what is actually generating this relentless mechanical buying pressure on a day-to-day basis, even without headline news? Welcome to the Gamma Engine, the hidden force that drives violent price moves even when zero fundamental news hits the wire. Here is how the loop works. Of the 185,470 options contracts currently trading on HIMS, an astonishing 83.67% of them are call options. The put-to-call ratio sits at an incredibly compressed 0.20. Open interest across all strikes exceeds 1 million contracts. When retail and institutional traders flood the market with call buying, the market makers who sold those calls face an immediate mathematical problem. To remain delta neutral, which is both a legal and an operational requirement, they must buy the underlying HIMS shares to hedge their growing exposure. That forced buying pushes the stock price higher. A higher price makes those calls even more valuable, which triggers even more call buying, which forces even more market maker stock purchases, which drives the price higher still. The loop feeds itself continuously, and once it is spinning at this scale and velocity, it takes a very specific structural event to interrupt it. And that gamma loop is currently colliding directly with one of the most dangerous short interest setups in the entire healthcare sector right now. There are 63.37 million shares sold short, representing a massive 30.05% of the total tradable float. The days to cover ratio sits at 3.86 days. Practically speaking, if every short seller tried to simultaneously close their positions at average daily volume, it would require nearly 4 complete trading days of pure, uninterrupted buying pressure just to absorb it all. When you combine the mechanical gamma engine with 63 million shorted shares that need to be covered under duress, the resulting dynamic is forced, prolonged, multi-day panic buying that snowballs on itself. This is the textbook anatomy of a violent short squeeze playing out in slow motion, and you are watching it happen. But before anyone gets too excited about chasing this momentum, Here is the hidden ceiling I warned you about at the very top of today's video. And this is genuinely the most important single number in the entire setup, $29.53. To fund the $1.15 billion eucalyptus acquisition, HIMS issued $350 million in zero-coupon convertible senior notes due in 2032. The exact conversion price on those notes is $29.53 per share. As the stock approaches that specific level, the mathematical fear of potential stock dilution becomes a very loud and very urgent conversation among institutional holders. This level acts as a severe psychological lid and a powerful structural resistance zone. Expect aggressive profit-taking as the stock enters the mid-$29 range, as funds positioned at higher cost basis step in to sell before any dilution scenario triggers. Respect that number. Do not dismiss it. Now, if HIMS does ultimately break cleanly above that ceiling with sustained volume, the long-term story becomes entirely about execution on two core business metrics that every serious investor should be tracking closely. First, subscriber retention numbers in Q2 and Q3. According to Bank of America's baseline model, HIMS needs to maintain a 40 to 50% market capture and retention rate to have any realistic shot at their $2.8 to $3.0 billion revenue guidance for 2026. If retention cracks, the stock follows it down hard. Second, margin expansion results from the eucalyptus platform investment need to begin materializing over the next 2 quarters. Capital deployed is fundamentally not the same as value created, and the market will eventually demand proof of that gap closing. For those of you actively trading the momentum right now, here is the exact tactical blueprint for June 2nd through June 5th, broken into 4 actionable zones. Zone 1 is your concrete floor. The 200-day moving average at $26.09 is hard support. Below that, $25 is the ultimate structural floor, and beautifully, that old options resistance wall has now fully flipped into a solid support foundation. Zone 2 is your optimal entry zone. Do not chase a 72 RSI print. Instead, wait for tactical pullbacks toward the $27 to $27.34 range, which aligns directly with key pivot support levels. Zone 3 holds your initial resistance ceilings at $28.17, scaling up toward $28.48, and Zone 4 is your magnetic target. The primary objective sits exactly at that $29.50 debt ceiling. If the 63 million shorted shares descend into full, uncontrolled panic, the secondary squeeze extension targets the $30 to $32 range. Now, before we close this breakdown out, there is something important I need to say clearly. Nothing communicated on this channel, not today, not in any video, not ever, constitutes personalized financial advice, investment recommendations, or any solicitation to buy or sell any security. I am not a licensed financial advisor or investment professional. All content on SmartStock SAM is created purely for educational and informational purposes only. Trading stocks carries substantial financial risk, and you can lose money, including your entire principal investment. Always conduct thorough, independent research and consult a qualified licensed financial professional before making any investment decisions of any kind. Past forecasting accuracy on this channel is not a guarantee of future results. Please trade responsibly and protect your capital above all else. So let us bring this entire picture together for the final time. The fundamental pivot is actively working. HIMS has successfully transitioned from a post-earnings falling knife into a validated, globally expanding holistic health ecosystem with real international reach. The technical ignition is undeniable. This momentum is being powerfully amplified by the $1.17 million insider purchase, a massive 30% short float sitting in a pressure cooker, and a dominant, self-reinforcing gamma hedging loop. Your tactical mandate this week is crystal clear. Wait for pullbacks near the $27 zone. Defend your downside firmly against the $26.09 200-day support, and treat $29.53 as the decisive battleground that determines everything about where this stock goes next. The setup is live. The mechanics are real. And this channel called it before the move began. Now I genuinely want to hear from you in the comments. Here is my question. Do you believe HIMS can actually break cleanly above $29.53 and successfully hold that convertible debt level as new support? Or does the structural overhang from that dilution ceiling cap this rally right here and send it back to retest? Drop your honest answer below. I read every single comment, and the Smart Stock Sam community's perspective matters. If this breakdown gave you real value today, hit the like button right now. It directly helps this channel reach more traders who need this kind of analysis before the move happens rather than after. And if you are not yet subscribed, do yourself a favor and hit that subscribe button so you are never on the wrong side of the next forecast. Now, here's something I want to talk to you about directly. If you are serious about leveling up your investing and trading, not just watching breakdowns after the fact, but actually understanding the setups before they develop, learning how to read the same institutional signals, options flow, and technical structures that we used to call this exact HIMS move days in advance, then I want to invite you to join the Smart Stock Sam membership community. Members get exclusive access to deeper analysis, early trade ideas, and priority replies so that you are never sitting on the sidelines trying to piece it together alone. This is the community for traders and investors who are done guessing and ready to start reading the market with genuine conviction. The link to join is right below this video in the description. Click it, take a look at what is inside, and come join us. And if you truly want to support independent analysis like this and keep Smart Stock Sam growing, you can also use YouTube's Super Thanks feature right below this video. Every contribution means the world and keeps this community alive. Until the next breakdown, trade smart, protect your capital at all times, and I will see you soon.